Hello everyone, I'm Miles. Today we're going to tackle a very practical problem, combining the tax shield effects of debt interest and depreciation and walking through all three major financial statements. We'll still be learning by solving a problem. Company ABC spends $100 to buy a piece of equipment, financed entirely with debt. The annual loan interest rate is 10%, and over the next 5 years, they will repay 20% of the principal each year. The equipment depreciates at 10% per year, and the tax rate is 20%. So, what changes will occur in the three major financial statements on the day of purchase and in the years after? Pause for a moment and think about it yourself. Remember, you only learn by solving problems. Always keep in mind the order of the three statements. We always start with the income statement, then move to the cash flow statement, and finally the balance sheet, making sure all three statements are perfectly balanced. At time zero, which is the day the equipment is purchased, things are simple. The income statement doesn't change. Cash flow statement. Negative $100 capex in investing activities. Positive $100 from debt issuance in financing activities. Net cash flow equals CFO plus CFI plus CFF, 0. Minus 100 plus 100 equals 0. Balance sheet. Fixed assets increase by $100. Debt increases by $100. Both sides are balanced. But after a year, the story unfolds. On the income statement, there is $10 in interest and $10 in depreciation. Pre-tax profit drops by $20, but since both interest and depreciation are tax deductible, there's a tax shield equal to $20 times 20%, which is $4. So net profit doesn't drop by $20, but by $16. On the cash flow statement, you start with net profit of negative $16, add back depreciation of $10, so CFO equals negative $6. There are no new purchases in investing activities, so CFI is 0. In financing activities, there is a principal repayment of $20. Note that interest expense on debt is already included in net profit, so it's already accounted for in CFO and won't appear again in CFF. CFF usually only includes the issuance and repayment of debt principal and dividend payments, not interest on debt. The final net cash flow is negative 6 plus 0 minus 20, which equals negative 26. On the asset side, cash decreases by 26, fixed assets decrease by 10 due to depreciation. On the liability side, debt decreases by 20, and shareholders' equity decreases by 16 due to a drop in net profit. Both sides decrease by 36, achieving balance. Here's the key point. Both depreciation and interest on debt will reduce profits, but thanks to the tax shield effect, since both are tax deductible, they help you save cash. Principal repayments reduce both debt and cash, but they never appear on the income statement. The three financial statements are not three isolated documents, but three perspectives on the same story. Finance and accounting have never been about rote memorization, but about seeing the invisible connections between the numbers. Once you see through these connections, finance and accounting go from being complicated to becoming clear.